Welcome back. So we are still looking at a cut of about 600 odd points, 630 to be precise. 24,000 is being held on to. The only green in the market has been few names from the FMCG space. So your Lever, Nestle, Britannia, Tata Consumer. That's about it. The rest of the market continues to reel under pressure. Rohit Srivastava, as promised, is with us. Rohit, every once in a while, when I think people think that the bulls are invincible, the market comes up with the lesson. It's been a pretty harsh one over the last, I think, 2 trading sessions. What have you made of the sell-off? And at a time like this, I mean, should you just go with, let's go by that traditional wisdom that's swept the market for the last 12 months? Or is it better to stand back and let the global picture settle?
No, I think it's time to step in. Today is an oversold market. We use this proprietary indicator known as the momentum swing, which is there on our strike platform, and it's reading at 2% right now. What that means is that 98% of stocks are showing negative momentum. So when we actually see 98% of stocks showing negative momentum, that's the day to consider buying. All you need to do is just be watchful of where the downward momentum wanes a little bit. We are seeing that now. I think at the end of the day, slight bounce from the lows, initial signs of reversal. We may see some more tomorrow, and so this is the time really to step in, because when there's, like they say, when there's blood on the street, it's time to get in, and you have to always like it if you're on the bullish side to get these moments for the good trades, because the investors will remain buy on hold. We haven't really broken either the 40-day, 50-day averages to say that the investment environment has been tarnished. So it's essentially the traders who take a hit in this kind of volatility. But the volatility provides us with this opportunity. So I think we are in that extreme oversold state, not just on the short-term Nifty, but also on a lot of the concern points, right? If we talk about, say, the Japanese yen, the USD JPY, the daily RSI essentially hit around 11 to 12 today. Extremely low reading. Now, these readings, happen once in many, many years. In some cases, sometimes in a decade or two. And when you see that kind of an extreme reading, you feel that, yeah, all panic has probably set in. So I would expect the dollar yen also to bounce back sharply from here in the coming days, which would sort of ease all this yen carry trade pressure that we are really seeing do the rounds in the market, and probably that's the bigger scare than the recession talk. I don't know which one it is. Is it this one or is it that one? The two have happened so closely that we are confused what is driving down the market. But simple thing, if you're this oversold, you should step in and buy. That's the underlying theme. And no, some of these markets are also not very overvalued. Like I just checked on the Nikkei, the PE ratio there is down to some 12 or something now. That's pretty low, compared to even us. So not a level at which you would be selling Japan.
So let's get straight to the point then, Rohit. If the markets are oversold and this is a good time to come in and buy, what's a relatively space, sector or a theme or a stocks that you would recommend to buy now?
No, so there's safe and there is trend, right? If the trend is not broken, you'd want to be in the strongest areas, and then there is the safe areas. I think the safety has already been proven in places like pharma and FMCG, which are probably down the least today. So that's always the defense. But I do prefer pharma over FMCG. So I would say having some pharma stocks, which are also one of the outperforming sectors of the last 6-8 months, is good on the defensive side. But on the other side, you go back to the winning sectors, whether they are, PSU banks. But I would also say private banks, because private banks, from their period of underperformance, if I just look at the Bank Nifty or the Nifty Financial Services Index, they all broke out post the elections from the 1-year congestion zone, and that pretty much signals that financials are on their comeback as things start improving in the next 6 to 8 months, and probably people will front run that idea. And now with the whole idea that interest rates are going to likely come down, something I've been saying for a while, is now more obvious to the street, then you immediately look at interest rate sensitives. So you start with banking, then you will go on to the auto sector, you will go on to the realty sector, and lastly, you would also not miss out on metals that typically benefit in the end from a weak dollar, strong bond market environment.
No, got that. Rohit, you're also a big watcher on, apart from the fact that, very quickly things have gotten to very oversold, like, for example, RSI on the yen, etc. How is the cycle? How would you assess the strength of the upcycle? And it's possible that we get a bit of a sharper slowdown in the US, right? So then some of this stuff will continue to play out. Maybe not the yen, but if the US recession talk continues. So then how does it all pan out?
So there's contradictory data when you actually look at the US. There have been some interesting tweets about it. If you just go back 1 week, you had GDP data which was actually showing over 2% growth. So now you have non-farm payrolls which are showing possibly job losses and an unemployment rate going up. And then you'll go and look at the PMIs which are still at the higher side. So what should we really go by at this point of time? So there are clearly two camps on this. There's the camp that things will go through or stabilize, and then there's the camp that thinks no, a recession has to happen. I'm probably in the first camp, and there's a reason for this. And the reason is that usually when you're in a deflationary environment, like I think everybody's watched the yield curve also over the last 3 recessions, and there are a lot of theories as to why some things have to play out in a particular pattern. I think this pattern was in a deflationary period when you didn't have an inflation problem. So typically when bonds sold off, money was going into equity. So interest rates would be rising as equities would keep rising. The opposite would happen then in a recessionary environment where stocks would fall and money would go into bonds. So there was basically an inverse correlation between the two. Now what we are seeing is more of a direct correlation, which means that as yields go down and bonds rally, stocks also rally together. And this is because of the inflationary environment. So in an inflationary environment, interest rates go up when there's inflation, bonds fall, stocks fall, and you end up getting a scare, right? That is what we saw in 2022-23. Since then, bond yields have been coming off, initially very, very slowly, which is why the recession talk didn't play out or people didn't get so scared. They thought that, yeah, yields are falling, but when they really fall sharply, we are going to get that recession. But I think in an inflationary environment, yields falling essentially a sign that the inflationary pressure is waning. And as interest rates get cut, you see stocks go up further. So you'll actually see more of a direct correlation, which is what we are seeing, I think, since 22, a more direct correlation between bonds and stocks. It may not have been true for the last 2 days because this is where the scare spread with the yen carry trade and so on. But that's only 2 days, right? Taking 2 years into account, there's one correlation, and then there's 2 days where people just got scared that, are we in the worst case scenario? But as rates actually start getting cut, which is now the expectation that people are building in, I sense equities will actually rally and interest rate sensitive sectors do well. In fact, even if you look at the US, just go back 2 weeks back, you'll see there was a rotation out of tech stocks right into the Russell and the US banking index, right? Both of them made new 52-week highs. And that was the rotation again, based on the same idea that, somewhere falling rates are going to spur interest into these sectors. So somebody started to front run those trades. And I think that's what will happen eventually. Once we are past this short-term knee-jerk reaction, as I might call it, you will see that rotation into many other sectors participating, which are impacted by rates.
Rohit, good explanation. Thank you very much for your time. As Rohit said, Rohit's view is that you should step in and start to nibble, right? If you're trading, if you're holding, if you're an investor, then you're holding on and you're looking at, of course, a little bit of damage to the portfolios. But if you're trading, Rohit believes that markets are oversold after 2 days of sharp selling. So 300 points on Friday, and actually we've come off a little bit more, 670 points right now on the Nifty today.